Good evening, everyone. Time for this week's silver update. The last time we spoke, I had given a projection based on this descending triangle that we would have an 80% chance of breaking out to the upside. As you can see on the daily chart, we have broken out to the upside. Let me bring it a little bit closer so you can see. We did a fairly strong breakout from this tested trend line. 1, 2, 3, 4 times tested, and then we got a break. So that was what I was expecting. Again, the volume that we had been citing was critical here because, as I pointed out many times, if we go up from these lows, then this is buying volume. That's extremely important because as volume increases on a downside move, that means that buyers are coming in. So it takes more and more sellers to move the price down, and eventually the price stops and the price reverses, volume stays high, and we turn around and go the other way. So a tremendously bullish example of volume if this is the case. So let's get back to the daily. I've drawn a couple of trend lines on the MACD. If you remember, I was pointing out the length of time for the 2008 low recovery of the MACD. It was a long time. It was 1, 2, 3, 4 months, 5 months really. And you can see the slope of the ascent of the MACD. Now, I pointed out that we expect to see a return to the zero line on the MACD in this current sell-off, and it's actually a much sharper slope that we're seeing and a much shorter time frame. So that's very bullish. That's very indicative that this bull market is not over. As I pointed out before, when you have a parabolic rise and crash, you normally get something like that. It's starting to look like that's not what we're seeing. That's what you would have seen here and there. So we're starting to look like we're not having a parabolic rise and crash, but actually return to the existing trend line. So that's very bullish. I'm very encouraged. You should be encouraged. 36.6. Remember this price because the first time we visited this price in the modern era, because remember the nominal high was $48 to $50, so we're still below the nominal high, which really should, more than anything, that should cause you to be buying with both fists, because we know that that nominal high was reached in 1979, and we know that the price of everything you can think of is at least 4 to 5 times higher than it was then. So the fact that we're still below a nominal high is just absolutely amazing. But if we go back, you can see that February, actually March, is the first time this nominal high was made in the new era. So we're back to where we were in March. Everybody said, well, that's a crash. Well, no, it's not a crash. It's just a correction in a very dramatic bull market. So I want to jump over to the SLV because the puts that we've got, or the put we've been following, has expired because the last date for this to trade was, as you can see, Saturday, July 9th. Well, that's not the date. Let's get the option here. It is, the July is, I'm sorry, it hasn't. It's got a week left. So it's July 15th. And our option, if you remember, was the July 25, and that's right here. And you can see it's still 52,000 outstanding contracts of volume, which is high. But if you remember, it was as high as 120,000 at its top. At one point, it was cut in half. We don't know if the person who bought it at 7 or 8 cents and it ran to about 20, 21 cents took their profit. We're not sure. But my prediction was it would go out, expired, out of the money, and be worthless. And we've got 1 week. So unless we go below 25 by next Friday, this will go out worthless. And you can see what the market's projecting. There's no bid for this. There's no bid for the 26. There's no bid for the 27. There's no bid for the 28. The bid for the 29 is a penny, and a penny on the 30, a penny on the 31, and 2 cents on the 32. So it's pretty clear that this option is going to go out worthless, and that was just some short-term play by some trader or hedger. We're not really sure. So let's jump over to the news, and I wanted to start with Eric King, and he has a article about John Embry and Andrew Maguire and about the Chinese market that's opening up. And if you just think about it realistically, as we're watching the decline of the Western powers, I call them the Anglo-American powers because I believe that's the age we're in, the Anglo-American age. England is the former empire, America is the current empire, but a lot of the puppet strings of the current empire are controlled by the former empire. So we're in the days of the decline of the Anglo-American empire and the rise of the Asiatic empires. So we're going to talk about the rise of the Chinese market for precious metals. And as you know, the Japanese have had markets for a long time, the TOCOM. But the Japanese are kind of a Western proxy. They're not really an honest market. They're not a outside market for the Western markets. So this is actual competition to the Western Anglo-American markets, and we're seeing those rise up in Asia. They're also rising up in Russia. They're rising up in the Arab states, and we expect to see more markets rise up to contend with the power-setting powers of the COMEX. So let's start reading here. Yesterday, London whistleblower Andrew Maguire informed King World News that he believes the new gold and silver exchange opening in China will destroy the gold and silver shorts. Today, King World News interviewed John Embry, Chief Investment Strategist at Sprott Asset Management, to get his take on Maguire's comments. When asked if this could create the upside explosion in gold and silver Maguire is looking for, Embry responded, "First, I happen to agree with about 99% of what Andrew Maguire says most of the time, and I certainly agree with this. It sort of encompasses two things. It's been well documented that Chinese interest in gold and silver is immense. They have a natural tendency towards it. They're getting wealthier, and now they are setting up an opportunity where the public can get easier access to it. So, to me, that just cements the demand side of the equation." Embry continues. The other side that Andrew knows a lot about because of his vast experience is the paper short positions that are carried by the bullion banks. The fact is, these things, short positions, are extremely vulnerable, and they can be taken out by physical demand. When the pricing mechanism changes from the paper market to the physical market, which is what Andrew is suggesting, this is the inflection point where the price of gold is going to go berserk. Silver even more so, because of the tightness in the silver market and the fact that the short position is even more extreme. When asked where the silver will come from to supply the new exchange in China, Embry replied, "Basically, the only way you're going to draw it, silver, out is by dramatically higher prices. I think there's a very distinct silver shortage. Unlike gold, there is still some left in central bank vaults. In this recent takedown in gold that took place over the last several weeks, clearly they accessed some central bank gold to assist their paper takedown. But this is going to be harder and harder to do in silver because there just isn't that inventory lying around that can meet sharp increase in demand. And you can read the rest of the interview. So, very bullish for silver. I think he's right that we all know that the bullion banks and the central banks and all the banks and the government of the United States, they don't have any silver left. They've been captured, if you want to use that term, by the SUA, the Silver Users Association, to supply under market priced silver for their industrial commodities, and now of course China. So we've reached the point now where the stockpiles of silver have been drawn down. This is nothing like the hunts, where the hunts were set up and the silver that the government had was roughly 10 billion ounces they could dump on the market. So the hunts never stood a chance unless they stayed strictly in physical and just stockpiled it. They didn't have a chance because when the shorts came in, they could back it with real silver, far larger amounts than the hunts could ever muster. So that is not the situation today. The situation is reversed from where it was in that day, in that there are no stockpiles of silver. The amount of physical silver stockpile on the COMEX and on the LBMA and the TOCOM are tiny amounts compared to the amount of money that could come in, which is billions of dollars. So, as I pointed out many times, there's an explosive position building up in the silver market, and as the short manipulation continues, the potential price explosion becomes that much more extreme. So let's jump over to Jason Hammel, because he recently released an article about the BIS data. And if you remember my last update, I was talking about the ratio of physical to paper and how the BIS data showed that the bullion banks are short an extreme amount of silver. Now, that was an idea I got from Jason, and the most recent article he sent out about that is how the BIS has actually modified their data. And I'll go ahead and read here. The Bank of International Settlements has changed or revised their silver derivatives data in the derivatives report. The change took place between their June 2010 report and their December 2010 report for the period of June 2009. The change was from $203 billion in other precious metals liabilities changed down to $93 billion. Now think about that. $110 billion worth of other precious metals just evaporated from the BIS. Now, that'll tell you something. Either the BIS is full of BS, or these numbers aren't accurate, or they're so desperate with Jason pointing this out. 203 billion. If you take $203 billion and try to put it in the physical market for silver, you will have a price explosion like you can't even imagine, because the market is so tiny. So we're starting to see the manipulation of the numbers, similar to the CPI manipulation and the BLS manipulation in the United States, and the manipulation of numbers. I personally think that they're actually changing these numbers because of Hammel's recognition of what these numbers represent. So let's keep reading. The change took place in Table 22A, amounts outstanding of OTC, equity-linked, and commodity derivatives by instrument and counterparty in their category of other precious metals for June 2009, notional amounts withstanding. In June 2009, the silver price was about $15 an ounce. This means that the $203 billion of silver liability divided by $15 an ounce shows that all the banks in the world that are tracked by the BIS owed 13.5 billion ounces of silver. But the entire world silver mining production is only 700 million ounces of silver annually. So this is an admission that the banks owed about 19.3 years worth of world annual mine production of silver. The adjustment from 203 billion down to 93 billion was a drop of 110 billion, or more than half the number. Can you say lost all credibility? The lower number, 93 billion, is still absurdly large at about 6.2 billion ounces of silver, or about 8.8 years worth of world annual mine production of silver. The obviously large and very excessive amounts are the smoking gun of silver fraud by Western world banks. This BIS data is extremely important because it is far larger than the excessive short selling amounts often noted at the COMEX, which typically is only about 1 billion ounces of silver or less. And he goes on. And he also has some links here of some PDFs that were the previous reports and proof that they altered their data, so that's interesting stuff. I'll go ahead and link this. But the game continues. There isn't enough silver to go around, and you should be glad, because as this game continues, there's still a chance to get into the physical silver market. It's not going to be much longer. There's not going to be many more days or weeks or months where you can buy physical silver in the $30 range. There's going to come a point in time where it's just simply unavailable. We don't know if the fraud of the COMEX and the LBMA and the BIS and the TOCOM and all the rest of them, we don't know how they're going to be exposed, but they're going to be exposed. And when they are, we can expect the price of gold to triple, and I expect the price of silver to go tenfold. So I think that you will see the price of silver move into the hundreds of dollars an ounce faster than you even have a chance to get on board. So your chances right now, and the shortage is still going on, you're still seeing delayed delivery dates at APMEX and Gainesville. A lot of people like the Patriot Radio guys, Eric and Joe, are reporting very hard times in getting physical delivery of silver. The Mint has announced that the proofs will be available, but they're at $60 a piece. So I've heard a lot of people talk about palladium and how they're bullish on palladium, and it's a great new thing. But honestly, compared to silver, all of these things are a joke. Silver has the most tremendous price potential of any commodity in the history of the world in the last 2,000 years. And this is still just the basing of the bull market. And you're going to see this bull market move. I don't know what point in time, but you're going to see this bull market move back up and go into the triple digits, and then even